Do not touch a single dollar of crypto in February until you finish watching this video. I am dead serious, and what I am about to reveal will change the way you look at this market forever. If you close this video right now, you are handing your money directly to the people who engineered what happened in January. We just witnessed something that the mainstream media completely failed to explain to you. In one single month, Bitcoin went from $89,000 to $134,000 and then collapsed back to $91,000 in just 72 hours. The people who made millions already knew this was coming before it ever happened. The people who lost everything were the ones who trusted the headlines instead of the data. January 2026 was not a crash. It was a perfectly designed trap, and most of you walked straight into it. I have spent the last 2 weeks analyzing every single transaction, every whale movement, and every on-chain signal from January. What I found will make your blood run cold, so stay with me until the very end. Now, before I break down the forensics, I need to know who is watching this. Pause and drop your location in the comments. London, Dubai, New York, Singapore, Lagos, because we are building the most informed crypto community, and I will reply to as many of you as I can. Let's start with the setup, because nothing that happened in January came out of nowhere. Every single move was telegraphed weeks in advance if you knew exactly where to look and what signals to follow. The year opened with Bitcoin sitting quietly at $89,200 on January 2nd, recovering from the late December sell-off. Most traders dismissed it as holiday noise, checked their portfolios one last time, and went back to scrolling their phones without a second thought. On January 3rd, something unusual happened on the Bitcoin blockchain that almost nobody reported. Over 42,000 BTC moved out of cold storage wallets that had not been active in over 3 years. These wallets were linked to sovereign wealth fund custodians, and the pattern suggested coordinated accumulation. The smart money was loading up quietly while retail was still celebrating New Year. By January 5th, Grayscale Bitcoin Trust saw its largest single-day inflow since ETF conversion, $890 million in 24 hours. This was institutional money entering through the most regulated door available. Bitcoin barely moved on this news, crawling from $89,200 to $91,400 over 3 quiet days. The market was completely calm. The volume was unusually low, and not a single trader suspected the biggest setup in crypto history was already taking shape beneath the surface. Then, on January 6th, the first real catalyst hit from a place nobody expected. The U.S. Treasury Department quietly released a report stating that stablecoin reserves backed by U.S. Treasuries had surpassed $180 billion. This confirmed the dollar's digital future was being built on blockchain infrastructure. For the first time, the U.S. government acknowledged that crypto was not a threat. It was a strategic asset. Bitcoin jumped 4.2% on January 6th alone, closing above $95,000 for the first time since mid-December. But the real action was happening deep in the derivatives market, where open interest spiked 18% in a single session, a number most retail traders never even look at. Whale wallets began accumulating even faster during the second week. On-chain data showed wallets holding over 1,000 BTC increased holdings by 14,200 BTC between January 7th and 10th. This was the largest 3-day accumulation in 12 months. Funding rates stayed neutral, meaning the market was not overheated yet. This was the phase where professionals were building their positions brick by brick, layer by layer. They were buying quietly, patiently, and deliberately, without creating any headlines whatsoever. By January 12th, Bitcoin had climbed to $103,400, breaking above the $100,000 psychological barrier for the second time in history. Unlike December's brief and failed touch of that level, the price held firmly above $100,000 for 3 consecutive full trading days before any meaningful pullback occurred. Ethereum followed with its own breakout, surging from $3,200 to $3,290 as Layer 2 adoption metrics hit all-time highs. The altcoin market was just beginning to stir, but the real fireworks had not started yet. Now here is where Act 2 begins. And this is the section that destroyed the most retail portfolios in a single month. Between January 14th and January 27th, the market transformed from a disciplined, fundamentals-driven bull run into full-scale speculative mania. The trigger came on January 14th when a leaked memo from a major U.S. bank surfaced on social media. The memo reportedly outlined a plan to offer Bitcoin as a reserve asset on client balance sheets. Within hours, the leak was trending worldwide across every major platform, and the memo was never officially confirmed or denied by the bank. But by that point, the fuel had already been poured directly into the fire. Bitcoin surged $8,000 in a single session on January 14th from $103,400 to $111,600. It was the largest single-day dollar gain in Bitcoin's history. Social media exploded the moment the news broke across every platform simultaneously. Reddit threads hit tens of millions of views, and TikTok creators were pumping out Bitcoin to $200,000 videos every single hour around the clock. Retail inflows into Bitcoin spot ETFs hit $2.3 billion on January 15th, shattering the previous record by 40%. These were individuals pouring their savings into a market that had gone completely vertical. The leverage across the system began ballooning during this phase. Total open interest in crypto futures jumped from $38 billion to $67 billion between January 14th and 20th. Funding rates turned sharply positive across every major exchange, meaning long traders were actively paying short traders to hold their positions open. This was one of the most classic and well-documented warning signs that the market was becoming dangerously over-leveraged. By January 18th, Bitcoin had reached $119,800, and the fear and greed index hit 94 out of 100. It was trading 140% above its 200-day moving average, a level only seen twice before. Altcoins went absolutely vertical during this window. Solana surged 95% in 1 week, hitting $420 per coin. Meme coins like Dogecoin and Shiba Inu saw 200% to 500% rallies in days. Retail traders were chasing the fastest returns available without any analysis whatsoever. On January 20th, a crypto influencer with 4.2 million followers posted, "Bitcoin is going to $250,000 in February." The video hit 30 million views in 48 hours, flooded with screenshots of leveraged positions. The whale accumulation that had defined Act 1 suddenly reversed during January 21st to 23rd. On-chain data showed wallets holding over 1,000 BTC began moving coins to exchange deposit addresses at the highest rate recorded all year. But this distribution was buried under the noise of the mania. Almost nobody noticed the smart money was already walking toward the exit. January 23rd marked the day Bitcoin first touched $128,000 intraday, before pulling back to close at $125,400. A perfect shooting star candle formed on the daily chart, a textbook reversal signal that every experienced trader knows. But in the euphoria, nobody cared about reading technicals anymore. On January 24th, Trump endorsed crypto adoption during a press conference as part of his economic strategy. He hinted at executive orders on digital asset regulation, and Bitcoin jumped another $6,000. By January 25th, total crypto market cap crossed $4.2 trillion for the first time ever. Financial advisors who had dismissed Bitcoin for years were suddenly recommending it to their clients. The derivatives data was screaming danger at the very top of its lungs, but absolutely nobody was listening anymore. Liquidation levels sitting below $100,000 had quietly accumulated to over $28 billion in potential forced selling that could hit all at once. January 26th saw Bitcoin surge to an all-time high of $134,200 before the afternoon session violently pulled it back to $131,800. The intraday rejection wick spanning $2,400 to $800 was the single largest candle rejection in Bitcoin's entire recorded history. On the evening of January 26th, something happened behind closed doors that triggered the collapse. 3 major hedge funds managing $180 billion held an emergency meeting to coordinate their exit. They had locked in over $3 billion in paper profits since early January. They decided to unwind positions over the next 48 hours in a carefully orchestrated fashion. January 27th opened at $132,000, and the selling began so quietly most traders did not notice. The price only dipped 1.2%, closing at $130,400. The hedge funds exited through dark pools and OTC desks, avoiding visible order books. On the same day, the Fed released minutes containing a single line most analysts completely overlooked. The Fed stated that digital asset markets pose emerging systemic risks that warrant closer monitoring. A seemingly routine line buried deep within the document. But this was the very first time in history the Fed had explicitly classified cryptocurrency as a systemic risk in any official communication. January 28th was the calm before the storm. Bitcoin traded tightly between $129,000 and $131,000, while fear and greed stayed at 91. Traders held positions with full confidence, unaware the ground was already crumbling. The hedge funds had completed 60% of their exit by midnight. Now I need to pause right here and ask you something very important, and I need you to be completely honest with yourself and with me. When Bitcoin was sitting comfortably at $131,000 on the evening of January 28th, what exactly did you do? Did you take any profits, or did you add more money thinking $200,000 was inevitable? Pause and comment, "I sold," or "I held." There's no judgment here, only the brutal lesson. Then January 29th arrived, and within 18 hours everything built over 4 weeks was destroyed. The collapse started with 3 events hitting within hours of each other. At 6:47 a.m. Eastern, A major exchange in the Cayman Islands halted all withdrawals for security maintenance. Within minutes, insiders leaked that it was facing a $1.4 billion liquidity crisis from an overnight hack. On-chain forensics later confirmed it was an inside job. Bitcoin dropped 3.8% in 20 minutes, falling from $131,000 to $126,000. At 9:15 a.m. Eastern, the SEC announced an emergency investigation into 3 major Bitcoin spot ETFs, citing irregularities in creation and redemption processes. Bitcoin fell another 5.2% in 30 minutes, crashing through $119,000. ETF outflow requests spiked as institutions rushed to reduce exposure. The third and final catalyst arrived at 10:30 a.m. Eastern and completely sealed the market's fate. A whistleblower posted proof that 3 of the largest market makers in crypto had been artificially suppressing sell pressure for the entire previous 2 weeks. This meant price action from January 20th onward had been manipulated. Real demand was significantly lower than what the market displayed. The sell-off turned into absolute full-scale panic within minutes of the thread going viral. Bitcoin collapsed from $119,000 to $105,000 in under 1 hour, recording the fastest percentage decline in Bitcoin's entire trading history. Liquidations exploded simultaneously across every single exchange on the planet. Within just 2 hours, $8.7 billion in leveraged long positions were forced liquidated. Nearly 30% of total open interest simply evaporated in a single brutal morning. The margin call cascade hit hardest among retail traders with 10x to 50x leverage. Thousands of accounts were wiped to zero within minutes. By noon, Bitcoin had fallen to $97,400. Over $1 trillion in market cap was destroyed in less than 6 hours. The panic did not stop at noon. It actually intensified as the afternoon session opened. Algorithmic trading systems that had aggressively chased momentum on the way up now amplified every single decline on the way down, creating a devastating, self-reinforcing death spiral. Ethereum crashed 42%, falling from $3,700 to $2,150. Solana dropped 58%, and meme coins lost 70% to 90% of their January gains. During the crash, whale wallets actually increased buying below $95,000. The same entities that engineered the sell-off were accumulating at the bottom. By 4 p.m., Bitcoin found a floor at $91,200, exactly where it was on January 5th. 4 weeks of gains were erased in under 10 hours. The aftermath devastated the entire global crypto ecosystem far beyond American exchanges. A major DeFi protocol on Ethereum alone suffered $340 million in liquidations as collateral values collapsed so fast that Oracle price updates could not keep pace. In South Korea, over 12,000 retail investors lost their entire crypto portfolios. The average loss was $47,000 per account, mostly first-time January investors. Bitcoin closed at $91,800, technically positive for the month by 2.9%. The January candle closed as the most dramatic shooting star reversal in Bitcoin's history. Now let's talk about February, because January's lessons directly determine your next 30 days. The technical picture is one of extreme damage that needs time to heal. The key support is $88,000 to $91,000, tested on January 29th and must hold for any recovery. Below that, $82,000 to $85,000 is the 50% Fibonacci level that would signal a deeper correction. Key resistance is $100,000 to $103,000, which will act as a ceiling before meaningful recovery. Above that, $115,000 to $119,000 is where manipulation allegations cast heavy doubt. Seasonal data shows Bitcoin declining in 6 of the last 8 Februaries. The average February return over 5 years is negative 8.3%, one of the worst months statistically. The SEC investigation adds regulatory uncertainty that will suppress institutional appetite. Until it concludes in 4 to 8 weeks, large fund managers will stay on the sidelines. The manipulation allegations will likely trigger congressional hearings in February or March. Headlines alone will create negative sentiment regardless of the investigation outcome. The bullish case rests on structural adoption that remains intact. Institutional custody, ETF infrastructure, and corporate treasury adoption did not disappear with the crash. Veteran traders who call the January 29th top are positioning for a bounce. They argue the liquidation flushed weak hands and the market needs 2 to 3 weeks to rebuild. On-chain data showed significant buying below $93,000 in the final hours of January 29th. Smart money views current levels as a buying opportunity, not a reason to panic. The bearish case is equally compelling. Manipulation revelations have damaged market trust, and retail confidence could take months to recover. Overhead supply from traders desperate to break even will cap every rally until allegations are resolved. Most analysts expect February to trade between $85,000 and $103,000. The real opportunity emerges in March or April if Bitcoin holds $85,000 through February. This is not a month to chase headlines. It is a month to accumulate. Now that you have the full picture, the whale accumulation, the leaked memo, the retail mania, the hedge fund exit, and the manipulation allegations, one question remains. What is your plan for February? Are you buying at $91,000 or waiting for $85,000 before deploying capital? Give me your strategy and price target in the comments right now. If this gave you clarity no other video has, hit that like button so the algorithm delivers this to every trader. The bull market is not dead, but easy leveraged gains are over for now. February is the month to accumulate quietly and build positions in the trenches. It is the month to prepare, not the month to chase headlines. The weak hands are washed out and tourists have left. What remains is the volatile market that crypto bulls forgot existed. For those with patience, conviction, and dry powder, January 29th was not a disaster. It was the invitation of a lifetime. Subscribe to this channel and turn on notifications because we track every whale movement and every signal through February and beyond. The market will test your patience in February like it has never tested you before. But patience is exactly what separates the traders who survive from the ones who disappear. Every significant crash in Bitcoin's entire history has eventually been followed by a recovery that made the previous all-time high look like nothing more than a stepping stone. January 29th will be no different. The only real question is whether you personally have the conviction and patience to hold through the storm. The on-chain data never lies, and right now it is telling a very clear and unmistakable story to anyone paying attention. The accumulation happening at current price levels is the single strongest bullish signal we have observed since October 2024. Watch the $85,000 level like it is the most important number in your life this month. If that level holds through February, the next leg up could begin faster than anyone expects. The manipulation story will dominate headlines for weeks, but markets have a short memory when it comes to scandal. By March, the focus will shift back to fundamentals and structural adoption. Kevin Warsh's confirmation hearings and the SEC investigation timeline are the two events that will move this market more than any price action in February. Follow those developments closely. Do not let fear make your decisions in February. Fear is exactly what the smart money needs to buy at the lowest possible prices. The traders who accumulate quietly during February will be the ones telling success stories by the end of Q2. The traders who wait for confirmation will be buying back in at $110,000 or higher. This is not the end of the Bitcoin story. This is simply the most uncomfortable chapter. Every great investment journey passes through moments that feel exactly like this. Subscribe to this channel and turn on notifications, because we are tracking every move through February and beyond. I will see you in the comments, and I will see you in the next video when we break down the first week of February in real time.